Understanding Financial Instruments, a Beginner's Guide. Investing can feel intimidating for newcomers, but it doesn't have to be. At its core, investing is about using financial instruments, tools that help you buy, sell, and manage assets effectively. In this video, we'll explore some of the simplest and most common financial instruments: stocks, leverage, and derivatives. By the end of this video, you'll have a foundational understanding of these key concepts, empowering you to take your first steps into the world of finance with confidence. Let's begin with the basics. Financial instruments are contracts or legal agreements that represent value and allow people to trade assets. Think of them as the tools or checkpoints that make financial markets function smoothly. They enable investors to buy and sell assets, manage risks, and grow wealth over time. There are several types of financial instruments, but today we're focusing on three beginner-friendly categories. Stocks, which represent ownership in a company. Leverage, a way to amplify your investment power using borrowed funds. Derivatives, such as options and futures, which allow you to speculate on future price movements. Now let's dive deeper into each one. Stocks are one of the simplest and most familiar financial instruments. When you buy a stock, you're purchasing a small piece of a company, essentially a share of ownership. This means when the company does well, you can profit through rising stock prices and, in some cases, through dividends. Stocks are bought and sold on exchanges such as the New York Stock Exchange, NYSE, or NASDAQ. Prices fluctuate based on factors like company performance, market trends, and economic conditions. For beginners, stocks are an ideal starting point because they're relatively easy to understand compared to other instruments. Growth potential. Stocks allow investors to participate in a company's growth and success. Dividends. Some companies share a portion of their profits with stockholders. Liquidity. Stocks can be bought and sold relatively easily on major markets. While stocks are a great way to build wealth, they do come with risks. Market volatility. Stock prices can rise and fall quickly, sometimes unpredictably. Economic factors. Broader market trends like recessions can impact stock prices. Stocks offer a balance of opportunity and risk, making them a great place to start your investment journey. Leverage is a powerful financial tool that lets you invest more money than you currently have by borrowing funds. It's like putting down a small deposit to control a much larger asset. Though leverage can amplify your profits, it can also magnify your losses, which is why it requires careful handling. When you use leverage, you typically rely on a broker to lend you money, often through a margin account. This allows you to trade larger amounts of assets than your actual cash balance. For example, with 10x leverage, a $1,000 investment allows you to control $10,000 worth of assets. Increased investment exposure. With leverage, you can make larger trades even with limited capital. Potential for higher returns. Because you're trading larger amounts, your profit potential increases. Leverage significantly raises the stakes. Increased losses. Just as it can amplify gains, leverage also magnifies losses, which can exceed your initial investment. Margin calls. If your leverage trades move against you, your broker may require you to add more funds to your account. For beginners, leverage can be risky and is best approached with small amounts or avoided until you've gained more experience. Derivatives are financial instruments that derive their value from an underlying asset, such as stocks, commodities, or currencies. They allow investors to speculate on changes in the price of those assets without directly owning them. Two common types of derivatives are options and futures. An option is a financial contract that gives you the right, but not the obligation, to buy or sell an asset at a specific price before a certain date. Call options. These give the holder the right to buy an asset at a specific price. Put options. These allow the holder to sell an asset at a specific price. Options are useful for speculating on future price movements. For example, if you think the price of a stock will rise, you can buy a call option and control the asset without fully owning it. Options can be used to reduce risks or to achieve specific investment goals. Futures are contracts that obligate you to buy or sell an asset at a specified price on a set date in the future. Speculation. Traders use futures to bet on the future prices of assets like oil, gold, or stock indexes. Hedging. Businesses and large investors often use futures to protect themselves from price fluctuations. Flexibility. Options and futures allow you to take advantage of both rising and falling markets. Risk management. Derivatives are often used to hedge other investments, reducing overall risk. Complexity. For beginners, derivatives can be challenging to understand. High risk. These instruments carry the potential for significant losses, especially when used recklessly. Derivatives may not be ideal for everyone starting out, but they are valuable tools for those who want to explore advanced investment strategies. Let's briefly compare these three financial instruments. Stocks, simple and direct ownership of a company, ideal for beginners focused on long-term growth. Leverage, amplifies opportunities and risks by using borrowed funds, recommended for experienced investors. Derivatives, complex contracts for speculation or hedging, suitable for advanced strategies. Each has its own role in building a robust investment portfolio. When starting, it's crucial to match your choices to your goals, experience, and risk tolerance. If you're completely new, stocks are a great place to begin. They're straightforward, less risky when diversified, and offer a solid understanding of how markets work. Leverage and derivatives should only be considered once you're comfortable with the basics of stocks and have a clear grasp of their risks. A key principle of investing is managing risks wisely. Here are a few tips. Start small. Don't invest more than you can afford to lose. Begin with modest amounts. Diversify. Spread your investments across various assets to reduce risk. Set limits. Determine how much you're willing to risk on each trade and stick to it. Educate yourself. Knowledge reduces uncertainty. Learn as much as you can about the instruments you're using. To begin investing in stocks, follow these steps. Research. Look for companies with solid financials and growth potential. Choose a broker. Open a brokerage account with a platform that suits your needs. Start investing. Buy stocks in small amounts, ideally in companies you understand well. For those curious about leverage, practice caution. Demo accounts. Start with demo accounts to understand leverage trading without risking real money. Low leverage. Use low leverage ratios to limit risk exposure. Avoid over-leveraging. Don't borrow more than you can repay comfortably. Tackle derivatives only after mastering the basics of stocks and leverage. Learn the essentials. Understand how options and futures work. Start simple. Begin with basic options such as call or put trades before exploring more advanced strategies. Use educational resources. Many brokers offer tutorials and simulators for beginners. Here are a few pitfalls to avoid. Overtrading. Trading too frequently can result in high fees and poor decisions. Ignoring risks. Always consider worst-case scenarios before entering a trade. Chasing trends, decisions made out of fear or greed often lead to losses. We've covered a lot. Let's recap. Stocks offer a simple way to invest in and grow with companies. They're great for beginners. Leverage can expand your investment power, but it also comes with increased risks. Derivatives, such as options and futures, provide tools for speculation and risk management, but require solid knowledge. Each instrument plays a role in building a diversified investment strategy. Financial instruments are essential tools for investors, each offering unique opportunities and challenges. By starting small, educating yourself, and focusing on risk management, you can confidently navigate the world of investing. Ready to take the first step? Start with stocks, build your knowledge, and grow from there. In future videos, we'll dive deeper into each concept and explore even more tools to help you achieve your financial goals. Thank you for watching, and happy